So, what if you're faced with a scenario whereby a client's equity is not enough to buy a rental property outright? Should they use debt and buy it anyway, or just continue with the one house they own now? Today's episode answers exactly that question. So, stick around and find out. Hi, I'm Russ, half the dynamic duo that is the Neon Bros. Today, we're going to explore how homeowners with significant equity can use a cash out refinance to purchase an investment property, even at today's higher interest rates, and even if they don't have enough equity to buy the investment property outright. In a prior video, we explained how clients can use their homes to purchase an additional investment property, yet pay nearly the same net monthly amount as if they owned only their original home. The key in that situation was to have enough equity in the first home to buy the second outright so that there'd be no additional need for a mortgage or mortgage payment. But what if your client does need a mortgage on the second property? Does having a second property still make financial sense, even if their monthly payment is higher? Assuming they can afford the higher payment and are creditworthy enough to secure a second loan, let's run the numbers to see if their overall financial picture improves or declines with such an additional purchase. As you know, this isn't the type of approach you hear from other real estate coaches, but if you find it valuable to help you sell more homes, please like this video and subscribe to our channel. I'm going to share my screen now to show you the example. All right, so here's the scenario now. So we're going to assume that a home was purchased about 5 years ago for $275,000. That's the primary home that the client lives in. And that the current fair market value is $390,000. So we're assuming that they bought it right kind of at the beginning of COVID. COVID made the real estate market go bonkers. And so they enjoyed a nice return, a lot higher than the normal rate of return probably would be on real estate. So the original mortgage rate back then, we're going to assume is 4%, and the current rate is 7%. So we're going to really kind of stress test this to make sure that it works even in today's environment. The original down payment on that property was 20%, which comes to $55,000, and that makes the original loan $220,000. So today, your client can secure a new loan at 75% of the current value, which is $390,000. So that'll come out to $292,500. So it's 390 times 0.75. So now we're going to go through the cash out refi example. So over the past 5 years, the client would have paid down about $21,000 in principal. So that would mean that he's got a balance. He started his balance off with 220. So he's subtracting out 21, which would leave a total of about 199 left as his equity, or actually as his loan, I should say. So the new loan that he's taking out is 292,500. The old loan that he's got to pay off is 199,000. So that means that the amount of cash that he's going to get out available as equity is 93.5. However, we're going to also, make this realistic, and we're going to factor in the costs. So we know that these loans cost money. It's not free. So we're going to figure that $10,000 is going to be the refinance cost. So that's going to leave him with about 83,500. But we're also going to plan for the fact that, this new house that he buys, if he does buy it, is going to require some repairs and some renovation and just to have some cash available. So we're going to assume it's $8,500. And that leaves us with a nice even 75,000. If we subtract 83,500 minus 8,500, that leaves us a very round number of 75,000 to put towards a new house. So let's say that the client is looking to buy a property that's worth about $250,000. With the $75,000 that he's got available from this cash out refi, that's a 30% down payment. So it's a nice healthy down payment. So 75,000 divided by 250,000 is 30%. So that should help reduce the monthly payment on that a little bit by putting in a generous amount as a down payment. But let's take a look at how the monthly payment will have changed. So on the original home before the refinance, the principal and interest, and we're just using a mortgage calculator here, just that you can find anywhere. We're assuming that property had a loan of $220,000 at 4%. So that comes to $1,050 per month. And we're just going to kind of eyeball this and say the taxes and insurance are going to be $250. So a grand total of about 1,300. I don't know if I'm crossing that out by accident, but it's 1,300. So now let's take a look after the refinance. So now the principal and interest is going to be a lot higher because it's a bigger number and it's a higher rate. So it's 292,000 versus the original 220,000, and it's 7% versus 4%. So that we know going in is going to be a lot higher. So in this case, it's $1,946 as your principal and interest versus 1,050. So it's a lot higher now, and we knew that going in that it would be. Taxes and insurance, let's just say it's a little higher at 325 since it's 5 years later. And that gives us a grand total of about 2271 versus the old amount, which was 1,300. So it's a lot higher. So it's going to be substantial. It's like 50% more, almost 60% more. So let's see if this really makes sense. We're going to stress test it. So let's take a look at the purchase price of the house. So we figure we're going to try to find a house of about $250,000. So this is probably going to be a condo or something maybe further out from where his original home probably is, to find a house that's a little bit less expensive. So $250,000. We're going to subtract out the $75,000 that we're going to get from our cash out refi. And that means that the loan amount that they're going to need to take out is $175,000. And now this is also going to be at 7% interest. So again, we're really kind of putting the screws to this scenario by making it really a lot more difficult and a lot more challenging to make sure that this it makes sense for this client. So at 7%, $175,000, again, just using a mortgage calculator, comes to 1164. We're just going to eyeball this and just say taxes and insurance will also be around 235. And in this case, because it's a rental property, we're going to assume that there's going to be a property manager, and property management is about 10% of rent. We're going to assume the rent here is $1,900. Again, a property that's 250, the old rule of thumb used to be you should be able to get 1% for rent, 1% of the price of the house for your rent, but that's not really true anymore. So we're going to assume he's getting significantly less than 1% of the value of the house as his rent. So 1,900 is quite a bit less than what would be the equivalent of 2,500. So we're going to play it conservatively and assume he's only getting 1,900 in rent, which means that at 10%, the property management fee is going to be $190. And that means that the total expenses are 1164 plus 235 plus 190. Whoops. And that equals 1589. So his cash flow is going to be the 1900 rent minus the 1589 expenses equals 311 as his net positive cash flow for that property. So now let's combine them just to see if having both these houses with a loan on them makes economic sense. So the first home, now that we did the refinance at the higher 7% rate, is going to be 2271, and then the rental property is going to be 1589. So that comes to a grand total of 3860 for the two properties. If we subtract out the 1900 that he's getting for rent, the net is going to be 1960. So the 1960 is still quite a bit higher than the 1300 that he was originally paying. So now, from a cash flow standpoint, this is definitely more expensive for him or her. So we have to see if there's other factors that make this still a financially savvy move for this client. So the things that factor into the financial decision, whether this is a good move or a bad move, are depreciation, the mortgage interest deductions, principal pay down, cash flow, and appreciation. So it's not just cash flow and appreciation, it's these other things as well. So in order to figure this out, we're going to have to know a little bit more about this client. So for the sake of this example, we're going to assume that this client is in the 22% effective tax bracket. Now that's not the marginal tax bracket that you hear about. This is actually kind of like a weighted average bracket. If you take what the marginal bracket is and you assume that all the dollars earned up until then are taxed at their particular tranches, then the effective tax bracket is kind of the weighted average. And by example, let's just say that the way the IRS works, it is that uh, a, a client has a $40,000 income, but the first $10,000 of income is taxed at 0%. And then the next $30,000 are taxed at 10%. So in that case, the person's marginal tax bracket would be 10%, but his effective tax bracket would be lower because they have to factor in that first 10,000 was only being taxed at zero. So it's going to be lower than 10% for the effective tax bracket. So we could talk more about that in a different discussion, but let's assume for this purpose that this client is in the 22% effective tax bracket. So that's the weighted average tax bracket. And that they use straight line depreciation over 27 and a half years to depreciate what's called the improvement value of the property. The improvements are not the land, that just is the building itself. The county calls it improvements, but what it really means is the building. So we're going to assume that the improvement value of this original home that the county assesses at $130,000. And let's also further assume that he uses the same thing, straight line depreciation for the rental too, and that the improvement value for the rental is 90,000. So let's also assume that both houses appreciate at 4% annually. So let's take a look at how that's going to look. So before the refinance, the original home, we're going to take a look at the depreciation factor. So we already said that that was going to be 130,000 divided by 27 and a half years. So that comes to $4,727. So at an effective tax bracket of 22%, the 4727 equals an actual tax savings of $1,040. That's actually what's going to hit this person's wallet. It's the amount that's actually going to help grow their wealth because they're not paying it out, and they normally would have been paying that out. So because they get that as a deduction, that's $1,040 more dollars that this person has to contribute to his net worth or her net worth than they would have had they not had this depreciation deduction. Now let's look at the interest deduction. It comes to, again, we're just going to use a mortgage amortization calculator and using the amortization table. It comes to, in the first full year, it's going to be $87.29 for interest on this property, on the original home, which was at 4%. So that came to 87.29. And at the 22% effective tax bracket, that comes to actually $1,920 that they're saving. Again, money that's actually hitting their wallet or saving them from having to spend. The principal pay down, again, using an amortization calculator, is $38.74. So each payment goes towards paying off principal, and each payment goes toward paying off principal and interest. I think I said that backwards. Some half part of it goes to interest, part of it goes to principal. So this is the principal portion. And the appreciation on this, we're assuming 4% for both houses. So the house started off at $275,000, appreciates at 4%, so that's $11,000. So if we calculate all of it together, if we add up all of these things above, that's 1,040 plus 1,920 plus 3,874 plus 11,000. So the actual benefit is 17,834. That's actually what's contributing to your wealth, to that person's wealth, to that client's wealth. If we break that down by the month, and divide it by 12, it actually comes to a $1,486 increase to this person's wealth. So since the payment on this property was only $1,300, the fact that it's bringing in $1,486 in wealth means that they're actually clearing $186 every month from the time that they purchased this home thereafter. So now, should they just do that and just stick with that house, or should they do the refinance on the original home to get a second house? So that's really what the whole point of this video is about. So now we're going to find out. So the depreciation on the original home, once we do the refinance, is going to be then 4727. Again, this is the same as it was before because depreciation is straight line. So that's going to be the same amount. So it's 4727 times 22. That's the same 1,040 that was above. That doesn't change. But now the interest deduction, that will, because it's a bigger dollar amount at a higher interest rate. So now, again, using an amortization table, we come to 20,381 And then we apply that to this person's 22% effective tax bracket, and we have an actual interest deduction savings to this person of 4484. The principal pay down, again, because every monthly mortgage payment applies towards principal and applies towards interest. So the part in the first year that goes towards principal is 2971. And again, this is from a amortization table. And the appreciation on this $390,000 house, because that's what it's worth now, at 4% comes to 15,600. So now if we total all of that together, it's 1,040 plus 4484 plus 2971 plus 15,600 for a grand total of 24,095. And if we divide that by 12 to figure out how much that annual wealth increase is by the month, we come out with $2,008. So now, with $2,008, since the monthly payment that we're paying on this is 2271, we're actually still in the hole by about 263, right? So 2271 minus 2008 means that we're negative 263. So now this is where we need the rental property to help kind of save the day for us, and we'll see if it does. So now the rental property, the depreciation, again, we're using 27 and a half year straight line depreciation. So that's going to come to 3273, and we apply the 22% effective tax bracket to come to an actual savings of $720. The interest deduction, again, using an amortization table, you can find these online anywhere. I would just caution you to use it if you're going to do this calculation, make sure it captures in the first year is a full year. Like right now, as we're recording this is October 2025. If I were to just do this right now, it would only capture the last couple of months of the year, since we're so deep into the year. So I would pretend that I was buying this property maybe in December of last year, so that way we capture all the monthly payments of this year from January to December to capture a full year's worth of payments. So if you're trying to do this calculation, just factor that in. So the interest deduction using an amortization table is 12,194. Applying 22% to that comes out to an actual tax deduction savings to this person of 2683. The principal pay down, again, just using the amortization table, is 1778. And the appreciation on a $250,000 rental property at 4% comes to exactly 10,000. So that means that if we were to look at the cash flow on this, we know that the cash flow was 311 times 12 for each, for the 12 months. So that's going to mean that we have an annual cash flow of 3732. That means that the annual wealth benefit is all these things added up: 720, 2683, 1778, 10,000, and 3732 for a grand total of 18,913, which means that the monthly, by dividing by 12, that means that the monthly benefit comes out to 1576. So since expenses and cash flow were already factored in for the rental, the monthly net inflow here is 1576. So that means that with the big picture, if we factor everything in, that means that the primary home, again, because the primary home doesn't get any rent, that's where the person is living, that's a negative. That's actually harming this person's net worth by $263 a month. The rental property is what carries the day. That's $1,576, which means that if you combine the two, you've got a net 1313 gain. So if you compare that 1313 to, to whether the person should even do this, and you compare that to staying with the original home and not doing anything, we say with the original home, you get a kind of a net inflow of wealth of $186. With the new proposed strategy, we have a net inflow of wealth of 1313, which means that the difference between the two is 1,127 a month, which is over 13,000 annually. So the key takeaway there is, even at today's higher interest rates, using a cash out refinance to purchase an investment property can significantly boost long-term wealth. Yes, it requires that your client have the income to cover a higher monthly outflow, But the combination of tax benefits, appreciation, and rental cash flow makes this strategy a powerful wealth building tool for clients, even if they cannot buy the rental property outright. So that's the answer to the question. Even if they can't buy it outright, it still makes, at least in this scenario, it makes economic sense to do this. Now, I know this was kind of a lot of detail and a lot of math in this. If anyone has any problems doing the math, and they would like my help on this, feel free to reach out to us. Contact us at the contact information down below, and I'll help you do this. And if you have a client on the, kind of on the hook that you think might benefit from it, I'd be happy to run the numbers for you. At least while this is a small channel and have the time to do it, I'd be happy to help you out and run the numbers. And if it's something interesting for the whole group, I would be happy to make a video on your particular client situation. Again, we'll leave their names out of it and all the confidential information, of course, but we can actually use their numbers and apply it to make a video at it and apply it to a whole situation that everyone can watch and learn from. So if you found this video to be helpful and you think the information might help you sell more homes, please like the video and subscribe to our channel. I'm Russ from the Neon Bros. Until next time, take care.